You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by PurePoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit uraniumspotlight.com, featuring in-depth market briefings, sector analysis, and the free Uranium Investor Foundation series. Essential reading for understanding today's nuclear fuel landscape. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's March 24th, 2026, and this week on Uranium Spotlight, a softer but still active spot market, the strategic importance of U.S. uranium and conversion capacity, and tightening implications from Kazakhstan's supply position. The uranium spot price closed last week at $83.75 a pound U3O8, down from an opening level of $85.50. The week was defined by weakening bids, softer offers, and a market that kept slipping lower as the days progressed. Early in the week, buying interest carried over just enough to push the daily blended price as high as $86.30, but that proved to be the high. From there, buyers stepped back, sellers adjusted lower, and the market lost ground into Friday. A total of 8 spot transactions were completed during the week for 750,000 pounds, all for prompt delivery. Even with the weekly decline, activity was not absent. March spot volume has already climbed to just over 3.1 million pounds across 25 transactions by the end of the week, which tells you the market is still functioning, just at lower price levels. What also stands out is the mix of deal sizes. The market continues to show a growing number of 50,000-pound trades, suggesting buyers are still active but selective, opportunistic, and unwilling to chase. That's a different tone from the stronger burst seen earlier this year. The term market, however, was quiet. There were no new formal utility requests or contract awards reported last week, although several utilities remain engaged, including a U.S. buyer evaluating offers for up to 1.5 million pounds over the 2031 to 2036 period. The latest published month-end long-term price for February was $90 a pound, which continues to show the gap between a softer spot market and a still elevated longer-dated incentive price. For investors, the key takeaway is that spot weakness last week looked more like a pause in immediate buying urgency than a change in the broader setup. The market is still trading real volume, prompt pounds still matter, and term buyers are still working in the background. The softer price action may pressure sentiment near term, but it does not erase the structural tightness that continues to build underneath. One of last week's most important corporate stories came from Uranium Energy Corp., but the broader significance goes well beyond a single company. UEC announced that it had added 3 more header houses at Christensen Ranch in Wyoming, with 1 more awaiting approval and 3 more under construction. On its own, that's a straightforward production expansion update. But in the context of the current fuel market, it points to something much more important. The United States is still trying to rebuild relevance across the nuclear fuel chain after years of minimal domestic output. Christensen Ranch matters because there are still very few operating uranium mines in the United States. That makes any incremental production meaningful, especially at a time when policymakers are talking about energy security, fuel chain resilience, and reducing dependence on foreign supply. UEC also said Burke Hollow in South Texas is operationally ready and awaiting final approval, which means this is not just about one Wyoming well field. It's about a broader attempt to expand U.S. mine supply from a very low base. But the more strategic piece may actually be the downstream move. UEC also disclosed a licensing milestone for its planned uranium conversion facility through its refining and conversion subsidiary. That matters because mining alone does not solve the American fuel problem. Uranium has to move through conversion, enrichment, and fuel fabrication before it can become reactor fuel, and conversion remains one of the most constrained parts of the Western fuel cycle. In other words, even if U.S. uranium mining rises, that material still has to get processed somewhere. Without domestic conversion capacity, the bottleneck just moves downstream. That's why this story stands out. It links 2 separate themes investors need to watch closely. First, the United States wants more domestic uranium production. Second, it also needs more domestic fuel cycle infrastructure if it wants that production to translate into true supply security. Mining headlines are easy to understand and easy to market. Conversion is less visible, but arguably just as critical. If the U.S. is serious about supporting reactor restarts, life extensions, new builds, and a broader strategic fuel position, then rebuilding conversion capacity becomes part of the same investment case. There's still uncertainty here. UEC does not provide new production targets in the release, and the conversion facility is still early in the licensing path. So this is not a story about immediate transformation. It's a story about direction. The company is expanding production where it can, advancing a second U.S. mine towards startup and trying to move into a more valuable part of the fuel chain at the same time. That combination is what makes the update more consequential than a routine operations release. For investors, this matters because it highlights where future value may be created in the U.S. uranium space. It's not just about more pounds from the ground. It's about building a domestic chain that can actually deliver mine-to-fuel security. And companies positioned across more than one step of that chain may end up with the strongest strategic leverage. If you want to understand the structural mechanics behind this, the full analysis is found in our Uranium Spotlight briefings at uraniumspotlight.com. The second major story last week centered on Kazatomprom, and once again the headline and the real investor message are not quite the same thing. On the surface, the company's 2025 results showed rising sales volumes and a plan for higher 2026 production. It also discussed 6 new prospective uranium areas and continued strategic expansion of Kazakhstan's mineral base. At first glance, that sounds reassuring. The world's largest producer is growing, exploring, and adding future capacity. But investors need to ask a more important question. Where will that uranium actually go, and how much of it will really help Western utilities? Kazatomprom reported that group sales volume rose 11% in 2025, while 2026 production guidance points to another increase. But it also made clear that costs are rising. C1 cash costs moved higher in 2025, and the company expects another sharp increase in 2026, driven in part by higher mineral extraction taxes and inflation. It also warned that 2026 production guidance remains subject to sulfuric acid availability. So even before you think about geopolitics, there's already operational and cost pressures inside the system. Then comes the bigger strategic issue. A large portion of Kazakh uranium is increasingly tied into long-term relationships and offtake structures that do not necessarily leave incremental supply available to the West. The draft story rightly emphasizes that Kazakhstan has been strengthening ties with China and Russia while also expanding sales relationships elsewhere. That matters because the market does not operate as one fully global pool. Western buyers do not just need uranium in theory. They need deliverable material with acceptable origin, logistics, and conversion and enrichment pathways. There's another layer here. Kazakhstan itself is moving towards domestic nuclear development. If that accelerates, even from a low base, the country may eventually want to retain more strategic value inside its own fuel cycle and power system. That does not mean an immediate withdrawal of material from export markets, but it does reinforce the broader trend. Large producers are increasingly thinking in terms of national strategy, not simply maximum export availability. This is why investors should be careful with optimistic assumptions around future supply growth. Yes, Kazakhstan can expand production. Yes, it's opening new prospective areas. But new mining areas take time, capital, chemistry, infrastructure, and execution. And even when new pounds arrive, they do not automatically solve Western procurement challenges. Rising production is not the same thing as rising freely available supply to the buyers who need it most. That distinction becomes even more important in a market where spot prices can look temporarily soft. Last week's weaker spot action might suggest less urgency, but a producer like Kazatomprom reminds us that structural tightness is about more than the next trade. It's about who controls material, who has access to it, and how much flexibility is really left once national priorities, long-term contracts, and operating constraints are taken into account. For investors, this matters because Kazakhstan's growth should not be treated as a simple bearish offset to the uranium thesis. The more realistic reading is that supply growth may be slower, more expensive, and less available to the West than headline numbers suggest, which keeps the case for higher incentive prices and strategically valuable non-Kazakh supply very much intact.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit uraniumspotlight.com. Join us again next Tuesday for another edition of Uranium Spotlight.